Hey guys, Drew here, and welcome to the Engineering Success YouTube channel, where each week I talk about different personal finance topics. And if you're interested in that type of content, be sure to subscribe so you don't miss out on any of my new videos. Today I'm going to be telling you guys about how in the last month during this economic downturn in March and early April, how I have been consistently buying stocks on red or down days, spending over $15,000 just in buying stocks long. And I want to share that with you guys, and I just want to keep you guys up to date with what I'm doing in the market right now. Do not just copy what I say in this video. These are my personal investment decisions, and you should always do your own research. But with that, let's get started with the list. And overall, it's 17 different stocks. And keep in mind, I did not buy these stocks all at one time. I don't think that that's a great idea. Instead, what I did is I started buying them when they got to a point that I felt was a good value and fit my margin of safety and risk tolerance. And then what I did is I just added a little bit more each time that they had a negative day. And this allowed me to dollar cost average down on these stocks and get them at what I see are very good prices for the long term. So to get started with the list, we have Facebook. Facebook is my largest individual stock holding. I have a lot of index funds and other ETFs and mutual funds, but for individual stock holdings, Facebook is my largest one. And on that stock alone, I put in just over $3 grand. So I'm pretty bullish on Facebook. And the reason is because it has very low debt. It's only 24% debt to asset ratio, which is very, very cushy. That makes me feel very safe with this stock and not feel like it's going to have any real issues with insolvency. When you look at them, and you're comparing to the other FANG stocks, which is Facebook, Apple, Amazon, Netflix, and Google, which is Alphabet. When you're looking at those big tech stocks, it's the only one of them that really fell enough where I felt like it had a good margin of safety. And I actually think that a lot of people view Facebook as already there and they don't see all the growth potential in it. Facebook owns Instagram, WhatsApp, and Oracle, all which I think are going to grow a lot, and they have a ton of cash that they can buy out other companies with. I just see Facebook growing a ton. And then when everyone is right now is using Zoom, if you like Zoom, check out Facebook Messenger's video conferencing. It's remarkably good. And then if you don't use that, WhatsApp has the same thing. And WhatsApp, while it's not as popular in the United States, worldwide, it is a beast. And so I see Facebook growing a ton in the future with ad revenue. Plus, I think that during economic downturns, it will actually end up helping companies like both Facebook and like Google with ad revenue, because companies that are more frivolously able to spend during a bull market on ads on TV networks, internet, and paper are less likely to spend on all of them and more likely to spend on the more targeted and more effective ones. And I think that that is the internet, and especially Facebook. The second stock is CVS. CVS is a healthcare stock. I'm assuming most of us know about CVS. It's similar to Rite Aid or Walgreens. It's got a little bit of a convenience store aspect to it, but with an in-house pharmacy. This to me means that it poses a low risk of having much of an issue during this economic downturn, because pharmacies and grocery stores are actually getting a lot of business compared to what they normally do, as people are mostly going to those types of establishments. So I don't see CVS getting hurt as much as a lot of other companies. And also don't forget that they're working on drive-through testing at CVS's. I do think that that will end up helping them just as far as building a company brand and a reputation that people will not forget about after everything is all said and done. And then the biggest reason that I have them is they have a very strong dividend. It's over 3%, and their payout ratio is only 28%, which means it is a extremely safe dividend in my opinion. I see it as a stock that I'm going to hold long term and that is going to be able to grow because it's down from what I view as fair value. Its P ratio is very low, and I see it as carrying relatively low risk. The third stock I've been buying is Delta Airlines. And this is one where we have a life lesson. I bought Delta Airlines a little bit too heavy, in my opinion, early on. And that was one where I kind of broke my own rule. I got a little bit excited and bought a little bit too much. So I'm down on it right now, but I do think I'm still in a good price point long term. There's a lot of uncertainty and risk, but I think that especially with taking the government bailout, which will probably end up decreasing their growth potential because of restrictions on stock buybacks and possibly restrictions on dividends, it could be a real issue, but it's below its 5-year lows. In my opinion, it's the best of the major American airline carriers. It's got a really good dividend that even if they cut short term, I think that they will go back to long term. And overall, I just think they're one of the best managed of the airlines. For number 4, we have Coca-Cola, which I mostly got for a dividend stock. and it's beneath its 5-year low, and it has a dividend that it has been growing consistently for 57 straight years. That is insanely good. This is a top of the line dividend stock, so I want to hold this long term. While I'm not a proponent of drinking soda, they have a lot of other products like Smart Water, Minute Maid, Dasani, and I think that they're very well diversified within the beverage industry, and I don't see that industry really going anywhere long term. The fifth stock is Hyatt Hotels. So Hyatt is obviously in the travel industry, so there's very high uncertainty and therefore higher risk in this area, but I think that means that we also have a lot more growth potential in this area. And within the hotel industry, Hyatt has the lowest debt to asset ratio and a PE of only 7, which makes it extremely attractive to me, especially when you're looking at a over 100% return possibility. Just if it returns near its 3-month high, it is by far my favorite hotel stock. Now for number 6, we have our first financial stock, and that is PACW, or PacWest Bancorp. PacWest Bancorp is based out of Beverly Hills, California, so in the general area, which is actually what turned me onto it. And then when I started looking into this company a little bit more, I saw it has a P ratio of only 4, which is extremely low. I mean, when you're comparing this to darlings in the banking industry from an investor standpoint, like Bank of America and Wells Fargo, this just knocks those out of the park, in my opinion. You have a book value of $30 per share, and this stock I'm getting in the 15s. That's insane. So we're talking about just its asset value alone. I'm getting a 1x return just from that. To me, that is a great deal. And I also like PacWest Bancorp because it's not as reliant on credit cards as a lot of the other bigger banks. And I think that is something that poses a high risk short term due to maybe insolvency issues, because I think when you have a high unemployment rate, that you're gonna have people that are not making payments. I think that the first payments that people will miss are gonna be credit cards. And so I think this is one that lowers my risk profile, but still gives me exposure to the financial industry. And it's locking in a great dividend that I want to have long term, plus growth opportunity within the banking industry, which is very hard to find. For number 7, we have another bank stock, which is Citigroup. And Citigroup to me is another one that doesn't rely as heavily on their credit cards. Its PE is 6, so again, very low PE ratio. It has a dividend of around 5% at the price point that I'm getting this at, and that's with a payout ratio of 51%. That's awesome. That gives me so much confidence that this dividend is, 1, not going to be cut short term, and 2, it's going to have room to continue growing for years and years as I hold this stock, and hopefully the company also appreciates in value. Because as I look at this company, I see that it has had a lot more consistent growth over the last 5 years than its counterparts like Wells Fargo and Bank of America. And just like PACW, this stock is trading at half of its book value. So again, we're looking at a stock that's trading in the 40s, and it has a book value of $83 a share. To me, this is the best bank stock right now. And for number 8, I have to give the credit for getting me to look into this stock to another YouTuber, which is Jeremy from Financial Education and Financial Education 2. And if you're interested in stock trading, definitely check out his channels. He has some great stock breakdowns that I really enjoy. And one that he brought up on his channel was Fizz, which is National Beverage Company. National Beverage Company, the main thing they're known for is LaCroix, which is seltzer water. And what's really great about them is you can see that they've fallen so much over the last couple years. They were at a high of $120 a few years ago, and when I'm buying it, I'm getting it in the 40s. I mean, this looks like a really, really good opportunity, especially when you look deeper into it and you see they have a lower PE ratio than Coke, which is awesome because I think they have much more room to grow than Coke does. And they have much better financials, and they have much better balance sheet and debt to asset ratio than Coca-Cola or Pepsi. In that industry, I just see them as a really, really great growth play. And right now, I'm already up 25% on them. I mean, I see this stock growing a lot in the future, and I definitely want to add more when it dips a little bit. For number 9, we have ERI, or Eldorado Resorts. So the big thing about Eldorado is that they are a US-based casino, and they are buying Caesars this summer. That's the main play with Eldorado. I see it has a lot of growth compared to, say, Las Vegas Sands or Wynn. And once it buys Caesars, it'll be the largest casino when you're considering properties within the United States. So I see that as a growth opportunity. Also, my cost basis on this is around $10, while the book value is $17. So that margin of safety of 70% is really, really attractive to me, especially when you consider that 3 months ago, the stock was trading in the 70s. So To me, ERI is a great stock, especially because I'm getting it so far below the book value. And I personally consider casinos to be less risky within that travel and leisure industry than, say, cruise stocks. This is my risky play, and I'm already up a lot on Eldorado, so this is what I'm going to be looking to add if it dips again. For stock number 10, we have SPCE, or SPACE, which is Virgin Galactic. This is, of course, Richard Branson's company, and it's a speculative and growth stock for sure. They don't have any earnings yet. It IPO'd late last year, and I just see that it has a lot of potential in the future, especially as someone that works in the aerospace industry. I'm excited about the ideas that they have about commercialized space travel. And because of that, I decided to look at it as a growth stock and buy some shares while it was down with the rest of the market. And I think this has a lot of potential long term. The 11th stock is Disney, which we all know Disney. I don't think it's going anywhere. Of course, it's hurt very badly right now because of parks closing, because of cruises, because of movie theaters closing. But I see Disney is very well diversified. My cost basis is $87 and it's normally around 150s. I see this as a great long-term dividend hold, especially because they have a lot of room to grow that dividend, and I just don't see it going where. I see it has a lot of growth potential, especially within streaming. Stock number 12 is iHeartMedia. So iHeartMedia is another spec growth stock. iHeartRadio has streaming, and it has other digital and radio broadcasting and even live shows once we're able to do those again. And so I really see that this is a stock that's been hurt a lot short term, but the PE is insanely low. We're talking about almost 1. And to me, that's insane, especially when you consider that its earnings growth have been good and it's done a good job on its balance sheet of fixing the debt issues that it had several years ago. And it's a profitable company trading at a PE of 1 with no real insolvency issues. To me, it's a no-brainer, and especially when I'm getting it for under $6, to me, that's an amazing option. And at number 13, standing at 6'6", coming from the North Carolina Research Triangle Park, we have GTHX, or G1 Therapeutics. And while I kid, G1 Therapeutics is based in the Research Triangle Park, which is in Raleigh, North Carolina, right near Chapel Hill, hence the reference. It was started in 2008. It's a growth company that does work on cancer research and therapeutic development. They have been losing money, but their losses have gotten smaller and smaller each year, consistently over the last 5. And I see that as a really good sign. So they're generally going to be a cyclical company, but especially when you consider that this stock was at near $70 and we're getting it for 10. And it's pretty cool to be able to invest in a company that is from the state that I grew up in. And number 14, we have AT&T, ticker symbol T. And this is mostly for the dividend. I mean, we're talking right now locking in a 7% dividend, and that's a 7% dividend with 35 years of consistent dividend growth and a payout ratio of only 60%. To me, this is amazing. You're talking about a dividend that is relatively safe with that payout ratio, very high dividend. The P is 15, which is, average. And despite that average P, I see a lot of growth possibility with AT&T with 5G technology coming out. And relatively speaking, when you're looking at other 5G exposure, I see this as a much less expensive stock because it has a lower PE than most of those other companies like Apple and AMD. For number 15, we have SAVE, which is Spirit Airlines. Spirit Airlines, I mean, it looks really good. In the past, I haven't been a real big fan of theirs because I'm not a huge fan of budget carriers, especially in a bull market. But in a bear market, I'm actually a pretty big fan of budget carriers because they tend to be much more agile than a lot of the bigger airlines because they have lower fixed costs, they have less equipment, and that means that they're able to adapt more quickly and not lose as much money as a lot of these others are struggling with. So much so that their CEO came out saying that they didn't need the bailout money, and so this makes me see them as a lower risk option within the airline industry. Number 16, we have MGM Resorts International, which is ticker symbol MGM, and this one is, yes, another casino stock. They have the lowest debt for casinos. This to me is the safest casino play because they have the most diversification with properties in Macau, China, and the US. So depending on which economies reopen sooner, they're not completely reliant on one country the way that Eldorado is. So I see it as a little bit more of a diversified play. Also, the book value is $24 and I was buying this for 10. So you're talking half of book value, a PE ratio of 3.5. To me, this is the lowest risk stock within that industry that has been hurt very badly. That being said, it has a little bit less of an upside than ERI, but I see it as still having a 2 to 4x upside over a 3 to 5 year period. And then 17, the last stock that I've been buying, this is another one that I have to give credit to Jeremy from Financial Education, and that is Foot Locker. So Foot Locker is ticker symbol FL. It's a retailer in malls, and they do footwear and apparel. And the big thing with Foot Locker is that we're talking about a company with a book value of $23 that I was able to buy in the 18s and 19s. So very good margin of safety. The stock has a P ratio of 5, was trading at double its book value in January. So I'm looking at possibly an 100% return if it's able to get back to normal. Only a 60% debt to asset ratio, so I think that they're going to be able to survive. And then the biggest thing is they have a dividend that at this price is at 7.4%. And that's with a 45% payout ratio. So that means they have nearly 60% of extra free cash flow on top of that dividend that's already massive. To me, that is just a steal, especially when I'm getting it at this low of a price. And they've been growing that dividend for 9 years, which is not, it's not a dividend aristocrat or anything, but that's still pretty good. Thank you guys for sticking around to the end of the list. Remember, while this is not investment advice and you should not just copy my investment strategy, I do hope this inspires you to be more active in investing and to consistently buying and dollar cost averaging on down days in companies that you believe in. And that way you'll invest more. In the comments, let me know what stocks you guys have been investing in or what stocks you want to invest in during the next downturn. And I'd love to see those. Also, be sure to check in the description box. There's a link for Webull. It's a great stock trading app that I really like. They have a mobile and a desktop app. If you sign up with that link in the description, then when you make an account and deposit $100 or more, you will receive 2 free stocks. So let me know what those 2 free stocks you got. Can't wait to see what you guys have been buying and what you think of my list. And thank you guys so much for watching. I will see you guys next time.